You move into a new home in Nevada. 6 months later, the comps in your neighborhood are lower. The value you thought you were building is evaporating. Suddenly, owning a home in the desert doesn't feel like an investment. It feels like a warning. From half-finished subdivisions baking under the relentless sun to investor-heavy neighborhoods drowning in supply, Nevada's housing downturn isn't speculation anymore. It's unfolding in real time. In this video, we're driving straight into the heart of that shift. 10 Nevada cities where price expectations are falling, risk is rising, and the dream is beginning to look a lot like a mirage. Stay with me. We're going past the brochures and the marketing slogans into the places where buyers are learning uncomfortable lessons after the closing papers are signed. And here's the part nobody puts in the listing description. In one city, housing demand crashed when casino floors went quiet. In another, those great deals have something growing behind the walls that inspectors can't ignore. If you're tired of hype and you want the truth before you take on a 30-year contract, then subscribe to Across US 4, because what we're about to uncover matters. Let's start at number 10, where the optimism has already run out. Number 10, Fernley. Morning in Fernley feels like a town holding still. Rows of beige stucco, for sale signs leaning in the wind, and freshly built homes waiting for buyers who never arrived. This community was supposed to be the affordable alternative to Reno, commuter convenience without the big city price tag. But demand cooled faster than anyone expected. Job cuts in manufacturing and logistics shook the local economy. Parking lots that used to overflow with workers now sit half empty. At the same time, updated flood risk maps pushed insurance premiums sharply higher, forcing some owners to reconsider whether they can afford to stay. Add in fast-built homes showing early construction flaws, and suddenly, budget-friendly comes with hidden costs. Fernley still has potential, but right now buyers are asking a fair question. How cheap is too cheap if the foundation, literally and financially, isn't stable? Number 9. Summerlin. Summerlin looks flawless at first glance. Perfect lawns, high-end retail, master-planned communities that feel like resorts. But climb past the marketing veneer and the pressure reveals itself. Owners who bought near peak pricing are watching comps soften. Sellers who once commanded bidding wars are now reducing asking prices just to get showings. Appraisals are conservative, deals fall apart, and luxury certainty suddenly feels uncertain. The real squeeze? Monthly cost. HOA fees, master plan fees, utilities, maintenance, and insurance stack on a mortgage that may already be stretched. Remote workers who moved here during the boom now face hybrid work mandates, meaning the commute they thought they'd never do again is back. Summerlin is still prestigious, but prestige doesn't protect equity when cost and competition rise at the same time. Before buying here, ask, are you paying for a lifestyle or a liability? Number 8, Elko. Elko's economy has one engine, mining. As long as gold companies expanded, home prices rose, but automation and slower demand changed the equation. When companies tighten, the housing market feels the impact instantly. High-wage jobs that supported mortgages shrink and listings sit. Infrastructure ages faster than budgets can repair it. Insurance costs climb in older neighborhoods. Workers leave for more stable prospects elsewhere. Elko still has culture, history, and pride. But financially, tying your biggest purchase to a single industry always carries risk. If the mines pause again, will your equity follow? Number 7, North Las Vegas. North Las Vegas was pitched as the smarter, newer extension of the valley. More space, modern builds, ideal for families and investors. But supply surged just as demand cooled. Entire streets of brand new homes sit dark at night. Builders offer incentives once unthinkable. Closing credits, rate buy-downs, even giveaways to move inventory. Meanwhile, strict HOAs enforce constant rules in neighborhoods where values aren't holding up their end of the deal. Buyers are asking themselves, is this stability or a polished version of oversupply? Number 6, Mesquite. Mesquite sells the retirement dream. Golf, sun, simplicity. Reality now includes climbing insurance costs tied to wildfire and heat risk maps. HOAs enforce rules with enthusiasm. Amenities that justified pricing, courses, clubs, recreation, face budget struggles. The question becomes, are you buying relaxation or a roster of rising expenses? Number 5, Henderson. The safe bet near Las Vegas until it wasn't. High-end buyers who stretched during the migration surge now face higher taxes, bigger utility bills, and special assessments that arrive without warning. Some neighborhoods show early signs of value softening, especially where newcomers financed at the top of the market. Henderson remains desirable. But desirability doesn't cancel math. Ask yourself, how many surprises can a budget take before a dream home becomes stressful? Number 4, Reno once felt like the next tech frontier. Silicon Valley escapees poured in, prices shot upward. Now the return trip is underway. Hiring slowed, corporate projects paused, short-term rental regulations tightened. Homes that once rented at premium rates now come with concessions just to secure tenants. Cities built for expansion often struggle hardest when expansion pauses. Investors who forecast a never-ending boom are rewriting their spreadsheets, and not in their favor. Number 3, Laughlin. When casinos dim, housing values don't shine. Tourism uncertainty has cut deeply into Laughlin's economy. Job instability reduces buyer confidence. Homes linger on the market. Insurance for river-adjacent properties continues to rise. If the primary industry that supports a city weakens. What supports your home value? Number 2, Sparks. Sparks was marketed as Reno's accessible counterpart. Developers believed demand would stay hot forever and built accordingly. Now, overhang is everywhere. Unfinished projects, vacant new homes, cautious lenders. Owners face rising fees in communities where equity is not growing with them. It's a market stuck in mid-sentence, waiting for a verb that hasn't arrived. Buying here means betting that momentum returns before bills outpace value. Number 1, Las Vegas. The Strip still shines, but housing? It's shifting fast. Investor unloads, longer market times, incentives replacing bidding wars, not to mention rising power bills from extreme heat. Water supply concerns, HOA oversight almost impossible to avoid. Tourists will always come to Vegas. Homebuyers are asking whether they should stay. The bottom line, Nevada isn't collapsing, it's correcting. But corrections bring casualties, people who bought the dream without seeing the risks. Low prices don't matter if equity keeps sliding and monthly costs spike. Before purchasing in any of these cities, ask, is the price a bargain or a warning? If you've experienced changes in home value, share your story in the comments. Someone else can learn from it. Like this video. Share it with anyone house hunting in Nevada. Subscribe to Across US 4 so your next move is Basie.